last week was a big earnings week, so I do want to talk about earnings. And another thing that crossed my eyes was a big explosive report from Hindenburg, and saw a lot of chatter around that. So we will talk about that as well. And anything else you guys have on mind? But we'll wait for some more folks to join in. But I think, yeah, of course, as always, we'll look at the macro level. And I think this previous week was a very volatile week, given the fact that we had a FOMC meeting, and with Chairman Powell coming and setting the tone for the Fed rates. And so a lot of, I would say, reaction from the market. So when you get the Fed chairman, the Fed rates plus the big earnings coming from the tech companies, from all the big tech companies, that's an explosive combination. So we did see that. Yeah, we'll get into the details of that and what I feel is a undercurrent in the market, right? And yeah, anything else that you guys want to talk about? Okay, so let me see if there is any other message. Oh, all right. So let's get going. I'm not sure where the rest of the crowd is today. Generally, we do see a lot more folks by this time, but anyway, doesn't really matter. One person is a crowd. So let's get going. Okay. So looking on the macro side of the house, what we see, again, we had a great, this Jan was a great January, and we also saw that the last week, the stocks continue to build on the momentum. A lot of encouraging signal from Jerome Powell. I actually heard the overall on YouTube. I went and heard the announcement, press so basically the Q&A with the press. I didn't see too much of a dovish tone coming from Jerome Powell. Right? There were a few times he did use word disinflation, but majority of the words coming out from his mouth were mostly hawkish. Right? But I think market just doesn't buy it. Market would hear what they wanted to hear, and the fact that he did talk about a disinflation a few times, market assumed that it's Fed is going to pivot. So I'm still cautious, but we did see a lot of stocks, especially the risk on stocks, going higher after the Fed announced, after the press, after the press meeting, right? So on Thursday, the S&P hit almost 420, right? SPX at 4,195, which is the best level since late August. And also there was a 23% jump in the Meta stock. We'll cover about what happened to Meta after their earnings. Or another signal could be if you believe in technicals, this is called as a golden cross, where in the overall SPX, we saw a 50-day moving average crossing the 200-day moving average from down. Right? This is considered to be a bullish trend. It indicates that the future trend is going to be bullish. Now, whether it's going to be, whether it's not going to be, we don't know. But this was, I think, first time in almost 2.5 years that S&P got the golden cross signal. So maybe possibility is those who are more technical traders became bullish with the onset of this signal. Or it could be short covering by hedge funds as well. If you go back in some of the previous sessions, we looked at how heavily some of these institutions' funds were hedged. If you look at the put to call ratio, the puts were the ratio from in terms of the puts, they were huge. So now if you are sitting and had a huge short positions and the market goes against you, there could be a run for short covering. Or I don't know, is it because of the new zero day to expiration options, which have been introduced in recent times, right? It's been 8-9 months, but we saw a lot of volume in options. So just last week, almost 250 million option contracts were traded, right? Sometimes, is it, a tail wagging the dog? With this whole zero DTE being introduced, I'm not even sure, what I interpret or what you see on a daily basis. Can you believe that as something coming from really fundamentals, or is it just the impact of a zero DTE options? And I think still it'll take me for a while to even understand this. Markets just tend to surprise, and then you wonder why it is happening. Is it because of a lot of interest on the options expiring on the same day, right? Ever since this was introduced last year, I believe we talked about it, I think two sessions ago. Some were introduced in April, and I think the SPX or the other was introduced somewhere in May. But now we're seeing a lot of interest coming on from in traders, not investors, because those are generally one-day speculators. You hold this position for just one day, right? So in one day, anything is possible. It could be a tail wagging the dog. It could be the market is moving just because of those option contracts being bought or being sold, and because of that reason, the market makers have to buy or sell the stocks to go back to delta neutral. So, but I think overall, if you look into or see the talking heads, most of the funds are considering that the rally is because of Fed's Chairman Jerome Powell's reaction and the signals that they could glean from his speech, right? Inflation may be under control, right? It's a disinflation. So that came on Wednesday, Thursday, market exploded. But then on Friday, we got a little surprise, right? Like James says, jobs number didn't knock the market down. Really odd. Yeah, this was probably after a long time, we saw that the good news for economy wasn't a bad news for the market, right? Most of the, over the last, I would say, 18 months, good news for the economy, good news for a job, generally has been a bad news for the market, because if the job is still strong, the economy is not going to break, and inflation will continue to be high. That was the whole idea. And good jobs coming up means Fed is not going to pivot. So we did get some surprise on Friday, because the overall jobs, 517,000 jobs were added, which was like triple the consensus estimate. Right? I just don't understand how come the economists with the PhDs can be so far off. I mean, I can understand if I come and give an estimate, that could be way far off, right? I don't have a crystal ball, neither do I have a PhD in economics, right? But the job numbers that came were 3 times what was the estimate. That just blew my mind off. Unemployment rate is 3.4%, which is lowest since 1969, right? Which is so surprising. So we did see just on Friday, market did react to it. I mean, when the numbers came out, We didn't see markets immediately reacting, but I think on Friday, probably market did end up lower for the day. However, I mean, it's still up for the week. So let me go back and look at where the SPY end up. Yeah, it was 1% lower. If you really look at SPY ended up just 1% lower on Friday. So, but overall, I think it's still a great January so far. James says daily options is roiling the markets. Option volume have exploded. Yeah, that's what. And I'm still not able to figure out what's the overall, is it really that, or and what's the quantum of the impact of it, right? But I do see a lot more options trading from a retail investor just after the zero DT was introduced. I mean, if you really look at the let's say out of top 20 most traded option contract volumes, 18 of them would be zero DTE. Right? That's how much is the interest is or how much is the volume that is being traded in zero DTE. James says bad results and the stocks moved higher. Oh, absolutely. So when the AAA earnings came in, right? Apple, Amazon, and Alphabet, miss, right? Apple's earning was like they missed the estimates for the quarterly estimates, first time since 2019, right? But the stock went up, like stock is up like 4% or 5%. Okay. So that was really surprising, or probably not surprising, because right now, a lot of movement in the stock market that we are seeing is because of what Fed is doing. And everyone thought that, Fed is now pivoting. Fed is dovish and all's going to be good in the market. So we did see a lot of a risk on trades coming back in the market. Animal spirits is back in the market. They didn't even give a good picture on the futures earnings. I agree. The other reason could be that some of these tech sectors were beaten a lot, right? Look at the Meta was down, 75%? I mean, Apple has been down by a lot. I don't know, let me just see if I can find out where is Apple. And many of these stocks the tech stocks have been beaten by a lot. So anytime, so even after this, Apple is still down 15-16% from all-time high, even after this gain. They are down 14%, like from 52-week high. I'm looking at Amazon. Amazon is still down 45% from that all-time high. Right? Which ones? The other one, big one we're looking at is Meta. Meta, I think, has recovered now, but it's still, even after this 23% jump that we saw in Meta after the earnings announcement, it is still down 50% from its all-time high. Okay. So many of these tech companies were taken to the woodshed, and maybe some semblance of cost cutting, which we saw a lot of these tech layoffs, having some semblance of, hey, we now need to focus on being cash flow positive. And those who have exited those stocks may be coming back in droves. Very possible, right? Who knows? But so what else we saw on Friday? There was a jump in services sector activity. Right. In December, it was below 50. Now it is back above 50. It's like 55.2. More than 50 means expansion in economy. So while I think now we're in two minds. Right? Can inflation come down if economy continues to expand? Right? Right now, all the indications are economy is expanding. When we look at these numbers, right? Services sector activity is higher, above 50, that means the economy is expanding. Labor market is so strong, right? And with these two numbers, if inflation is not going to come down, is there a possibility that Fed will go back to raise Fed funds rate from 25 basis point to 50? This week they raised it by only 25 basis points, right? Which is what market had been expecting, or market had been. Sometimes I feel it's like market had been guiding and Jerome Powell's hands are tied. Anyway, so there's been a whole cry around 25, 25, 25, and that's what FOMC gave us. Okay, you get 25 basis points. Now, even the expectation is that the next one, which is happening in March, is going to be 25 basis points. But given the numbers that we are now seeing, and let's see, we will also get the inflation numbers next month. If the inflation continues to stay hot, labor market continues to stay hot, like it is, like 3.4%, lowest since 1969. If this continues to stay hot, what if could Fed become hawkish again? And instead of doing 25 basis points, could it go back to 50 basis points? I don't know. I don't have a crystal ball, but if that happens, we should see what Mike Wilson has been predicting, that stock market is still has to go back to what 3,500, 3,200 before it goes back up. But so far, Mike Wilson has been proven wrong, at least in January. So if you're looking at a last week, since year to date, right, NASDAQ is up 15%. I mean, this is the gain that you generally get over in a year, like 15%. But now we are seeing, as of in 4 weeks, S&P 500 is up 7.75%, almost 8%. So is it too much too soon right now? I don't know. But I'm being a little cautious. If I'm still staying in the market, but being a little cautious. Right? From a sector perspective, we really look at communications services were up more than 5%. IT up more than almost 4%. Discretionary up 2%. Nothing much changed as compared to what we saw in the previous week. Overall, S&P index, even though on Friday it was down, but overall it is still up almost 1.5%. So very, very strong performance from the overall market, 7%, 7.73% in month of January, which is great. If you stayed invested throughout the whole downturn of 2022, you're being rewarded in the first month of 2023. That's all I can say. But yeah, a lot of conflicting signals. And I am, like I said, I'm being cautious. I still continue to get the regular investment, but continue to focus on reducing the overall portfolio deltas. That's what I've been doing. Naresh says tech layoffs continued few more weeks till severance package runs out. Yes, and the other thing is, on the positive side, when it comes to the company earnings, the impact of the layoff, the cost saving coming from these layoffs was not reflected just now. So probably for companies like Alphabet, you will see those gains. When I say gains, means gains in company performance, in cost saving. Those will start to show up in 2 quarters later, because they gave what 5 months of severance package. It was yesterday or day before. HubSpot, which is your marketing online management tool, they did a layoff, but Twitter and LinkedIn, a lot of information, a lot of chatter around how well they handled the layoffs. I think HubSpot they handled the whole layoffs really well. Naresa, zero DTE is like a lottery to me. That's exactly true. It is also, I mean, these these kind of products come and go. We've seen a lot of interest in binary options. Zero DT is almost similar to that. But I guess it does have a place for someone, not for me though. Inflation will not come down unless crude oil comes back to 40 to 50 dollars per barrel. Oh, that's really very gloomy scenario. But if China reopens, then inflation, then the crude won't come to, fall at come back to 40 to 50 dollars. If China reopens and opens its economy, because that's a big consumer of oil. So I don't see that coming back then pretty soon. But if we were to believe Howard Marks' third sea change, maybe we will never go back to 2% inflation rate. Okay. Over the last 12, 13 years, what we have been thinking is a normal, maybe last 13 years were not normal years. Those were the abnormal years. 0%, zero interest rate policy, 2% inflation, probably not a normal. Maybe we go back to the normal where your Fed rates are 3%, 4%. Maybe that would be a new normal. That's a third sea change that Howard Marks talked about. We also reviewed it, I think, in the last session. Right? So those investors who have who came in the market, let's say last 15 years, probably all of us are puzzled on this. 2022 has been very abnormal. Maybe 2023 is going to be abnormal. But what we don't know, and what may be true, is maybe this 15 years were abnormal. Now we are going back to the normal state. So things that worked in the last 15 years may not work anymore. Interesting one. And I'm here to learn in terms of, hey, how do we still stay and survive in interest, in an area where you don't have zero interest rates? Lot of startups are learning this lesson. And despite all what we are seeing in the markets, all the layoffs, even in the big, a lot of startups have closed their shops. Many of them have laid off people because they're just can't, you can't just raise funds at the same valuation what you were able to do earlier. I was reading, I don't have the tweet thread right now. Maybe I'll share it in the next session. Is the worst is yet to come when it comes to the startups. And looks like it's like end of 2023 till mid of 2024 is where we should see a lot more startups and, folding their shops. Because it's completely different environment in which these companies are asked to operate, which many of the founders don't know. Nuret says, what else? Okay, James, Fed secretive trade desk is still doing QE unbeknownst to the massive. What's the source of that info, James? What exactly you're trying to say here? Little conspiracy theory around what Fed is doing. Let's look at Fed balance sheet. Because if I look at Fed balance sheet, that is trending in the right direction though. But job is not done. We still have way more to go down. Google set aside $4 billion for severance package. That is true. Sam said, did you talk about Palantir P ratio last week? It's around 46. Yeah, Palantir is, I didn't talk about Palantir P ratio, but we did talk about Palantir as a company. Today, if I look at Palantir, for me to look at any value from Palantir, I'm not going to consider PE as the right ratio for them. Because company is not optimizing its operations for profit. So then I don't want to judge them on profit. I don't know, a few weeks ago or whatever, we did talk about maybe many weeks ago, many months ago, we did talk about the various valuation ratios and how we could use, which one probably we should use depending on what stage the company is in its life cycle. If the company is still in the stage where they're trying to find product market fit, there is almost, you can't even use price to sales ratio. Forget price to earnings. You can't even use price to sales, right? And that time, I think I'd coin say you have to just use price to hopium ratio. There is absolutely no ratio that makes sense. If a company has moved from a product market fit to a stage where now they have a customers, they are growing, they are, just got their Series B, C kind of a funding, or they are very, if Inwood has become public, but they are still focused on growing their revenue, then again, you can't judge them with, let's say, PE ratio just yet. Right? So when I look at Palantir, I don't look at PE, or PE is 46. So, but if they are growing revenue, especially the mix of the revenue that we talked about last week, that's what I look at when I look at Palantir. But again, Palantir surprised me. I mean, with this growth, like I said earlier, I bought some 6, 7, and again, I don't claim to have a crystal ball. My thesis on Palantir I already discussed last week, but I was surprised on what is driving this. Right? Again, this could be a lot of risk on assets, and companies like Palantir and some of the others will talk about. They all were going high. Tech sector from levels of from layoffs.fyi from levels.fyi in 2021 to layoffs.fyi in 2023. Oh, absolutely right. James, it's okay. So you're saying the Fed is doing the off balance sheet buying treasury bills a couple of weeks ago. How come markets moved 5% lackluster earning and vague future prospects? So even I'm surprised on what made market move on this earnings. Like, it looks like earnings really doesn't matter, right? The only hint I could get is market assumed by the demeanor of Jerome Powell saying he's not going to be hawkish anymore. We're done with it increasing the rates. Maybe we'll get another 225 basis points and then no more rate hikes. That's the only thesis which I could come up with why the market went high. And like I said, after office, I came back, and after dinner, I was listening to Jerome Powell's on YouTube, listening to this press conference. He didn't sound too dovish. Of course, he dropped a few disinflation words, but he didn't sound too dovish. But market probably is not believing it. Anyway, easy money incoming. Possible, if and that may not be coming from Fed, but if you don't see increase in interest rates, then endowment funds, pension funds, family offices, hedge funds who've been waiting on the sidelines or have been holding fixed income instruments may come back into the stock market, and that will, pump up the markets. So does the stock market enthusiasm does reflect the consumer health? Now that's little scared me. Is if you look at the stock market returns as of end of January, Spotify up 43%, Shopify 42%, Amazon is up 23%, even though Amazon is still down 45% from its all-time high, but it's still up 23% in month of January, and so on and so forth, right? But on the other hand, if you look at a consumer in USA, we are back on a trajectory for our credit card debt. So for during the COVID, consumers started saving, held back on any spending, of course, because where you would have spent? You're in lockdown. But now, consumer is back on loading the credit card debt. Not just a credit card. I also saw some more numbers, which does shows that even though the stock market is showing us that everything is good, but consumers' health doesn't seem to be that good. So credit card balances, as we looked at, up back to $930 billion. Personal loan balances grew by nearly a third to $222 billion. Monthly car payments continue to rise. So average monthly payments rose to $718. Delinquencies ticked higher. Percent of credit card loans that were at least 90 days rose to 2.26%. Personal loans delinquencies rose by more than 1%. Auto delinquencies rose to 1.78%. Right? So when it comes to consumer is being squeezed. Could be because of inflation. Number two, I don't think those layoffs have anything to do, because the type of consumers or the employees that are being laid off, those come from a well-off industries, right? The layoffs are happening only in tech and the financial sector, Wall Street and the Silicon Valley, and I don't think those consumers are being squeezed. But because of this inflation, the other consumers are having tough time. So not all is good when it comes to the overall the market. If I look at even the US market, from US market, whether expensive or not, of course it has come down now from somewhere around 35 P to E ratio. Again, price to earnings is a very commonly used method when trying to value a company. Essentially, it tells us that what's the price I'm paying for a dollar of earnings that the company is making, right? If the PE is higher, it means I'm paying a lot. It means the company needs to. I'm buying it at an expensive item, so this company be better continue to perform because I'm buying it at expensive level. So overall, US market PE has now come down to 22, still higher from the general average. So generally on an average, PE stays between 15 to 18. So still way higher, even, and this was, I think, at end of 2022. So now considering that in January, we saw another 6%, market went up 6%, this P probably has ticked further higher, right? So is it still cheap? No. So there is another chart that I came across, and that talks about not PE, but CAPE. Right? When I look at this chart, US is still higher, it is like 20, almost 25. So CAPE is a better method than just PE, because this is cyclically adjusted PE ratio. I do want to talk about a little bit of this, of why it makes more sense to look at CAPE ratio than a pure PE ratio. From that perspective, US is still higher, right? Almost at 25. Whereas you look at China is almost 50%. Valuation perspective, 50% cheaper than US market. Right? Generally, US market have had a higher valuation over the past 10-15 years. But of course, China is cheaper for a reason. For many funds, for many institutions, China has become uninvestable because of sovereign risk. But right now, I see a lot more value in other markets. India is even more expensive. Probably India has come down now based on what's happened over last 2 weeks in India. But by the end of last year, it was still way more expensive. Even more expensive than US, right? So do want to talk about why we need to look at K. Before that, stocks. I say, since we're discussing now recently, it's on 90% stake last week and down to 4K from 60K. I saw this tweet today morning saying he sold some 27 million worth of shares. I think someone had posted the 13F the filing from the SEC filing that is now down to almost 4K shares. Yeah, that's a head scratcher for me. I am not against, or I don't ding companies when the CEO sells the shares, but in this case, I am a little worried because the remaining amount of shares is only 4K. If we had sold 60K shares and still holding million shares of now, I wouldn't be worried about it. But this does cause me to take a pause and say, what is happening here? I saw it like today morning. I saw a tweet which talked about this, but I don't know. I haven't got into the detail of what happened. Were those generally these are predetermined sales, right? So I don't know. Then surprised me that he has got only 4K shares available to him, which seems to be too low. So as if, I don't know. So I didn't have a time to dig deeper. This 4K seems suspiciously very low. But when I saw this, I was a little concerned about it. Okay, there's a link from Zero Hedge, which talks about three-year Treasury auction shows record demand for first coupon sale of 2023. No CPI jitters. Okay. Thank you. Let me just save it for later. Okay, for reading later on. Historical buyers are no longer buying US Treasury debt. China, Japan, SS Trust Fund, they are no longer. Yeah, most of the other countries, they're actually cutting down on their US Treasuries holding. What's the website where you get Treasury? We used to see which website where we had all the foreign holdings of US Treasury. I forgot that link. But we have seen over time, and especially those who are trading with China. China has been trying to do more and more yuan-based trading. China has been reducing its US holdings. Japan, I think, had reduced its US holdings. Overall, the treasury holdings of other countries is coming down, right? We have to be ready with a scenario when the US dollar's hegemony is no longer as what it used to be, right? This is a cycle that plays over long period of time. If you go and look, read through the book of Ray Dalio, where he talk about how the world power changes, every 150 years, you'll see a new world power coming up, right? New world reserve currency. So now, US dollar has been for more than 100 years already. Prior to US dollar, for around 150 years, it was sterling pound. Prior to sterling pound, it was Netherlands guild. So every 125, 150 years, on an average 150 years, you'll see the world order changing. It's a thick book, I think that the book name is Changing World Order, Changing Market Order. I think it's a Changing World Order. Ray Dalio very beautifully explains on, and we don't see the effect of it in one generation because there's a really long cycle. So I'll be foolish to think that US can continue and to be the boss of the world, and US dollars will continue to be world reserve currency in eternity. So we are already seeing the overall share of US dollar-based trades in the world market is coming down. From more than 85%, it is now down to less than 70%. A lot more trade has started to happen in non-US. Even our friends from Saudi, they are open to trading and selling oil in a currency other than US. That's going to be really, really, that was the reason why US was world reserve currency. After, that's why it's also called petrodollar, right? You won't sell your petrol or oil in anything else but dollars. But now that's being challenged. Asif, now form 4, so mostly not preset sales. Yeah, then I'm will be worried about McDermott sale. Okay, yeah, who owns the US national debt? Yeah, I think this is, but there was another, let me just see if I can find that page where you see the latest who hold US where we don't have it here. I've shown that many times, but now I can't find it. Okay. All right. Coming back to PE versus CAPE ratio. PE, like I said, pretty common. It's price to earning ratio, which divides the price of a stock by annual earning per share. So normally, we would want to buy a healthy growing company when it is trading at a low PE. Right? The company is healthy, it is growing, but the PE is low for whatever reason. Sometimes PE could be low because the rival has gone down and suddenly the market thinks, oh, they'll put all the companies in the same basket and would sell off, even though nothing has changed in your company business, right? So if you are having a healthy and growing company trading at a low PE, you are paying less to get some good amount of earnings, right? But the problem, which we may be right now going, is during a recession, the stocks will fall, means the price will go down, but the earnings will fall sharply as well. So when the price goes down, your PE goes down, but the earnings also go down, and sometimes they go down faster than what the prices go down, and which will inflate the PE ratio. And you would think, that the market is still expensive and we shouldn't buy. Whereas in the recessions, that's the best time when we should actually go and buy. Right? When there's the blood in the market, we should be out shopping. Right? So Robert Shiller, a Nobel laureate, created CAPE ratio, which is a cyclically adjusted price to earning ratio, which kind of takes the sting away from the recession. So it looks at the average of last 10 years of earning, adjusts them for inflation, and then divided by the adjusted earnings. So why it is important? Empirically, Robert Shiller looked at last 130 years of back tested data and found that your returns of S&P over the next 20 years are inversely correlated with the CAPE ratio. So given at this one, just go through the chart, won't easy to understand. If your CAPE is higher than 22, that's your overvaluation. Market generally doesn't return much. If you look at over here, over 22, markets have been range bound for this period. Same is the case for next 10, 15 years, market stays range bound. Right now, we are looking at a CAPE ratio of 24. This we are talking about more than 130 years of data. Of course, next 1 week, market can rip higher, 10%. Over a long term, next 15 years, these are sometimes called the lost decade when, hey, market hasn't returned anything. So to me, does look like that US market is still expensive when you're looking at this particular ratio. Okay. So thought I'll share because from a PE perspective, right now it's 22, but if you look at a CAPE, it is still 24. All right, looks like James had got a yield curve inversion. I generally don't look at 10 to 3 months. I generally focus on 10 to 2 year. Yeah. So even the 10 to 2 year yield curve is it's better than where it was a few weeks ago. I think a few weeks ago, it was like the worst of last 40 years, but still yield curve stays inverted. And yield curve inversion is if there is any indicator of a recession, yield curve inversion comes closest to that. So now whether it's going to be hard landing recession, whether it's going to be soft landing, this week market thought is that Fed will be able to engineer soft landing. And that's why we saw markets going higher. But no one knows. Right? Because the yield curve still says, there are many conflicting signals because I'm being cautious. Look at a fear and greed index. We're back into the extreme greed. Again, driven by a lot of a call option buying volume in stocks like Tesla. Was it 3 days or 4 days ago, wherein Apple was the fourth. Generally Apple will stay the top when it comes to individual stocks. Apple generally will be the top one or the second one when it comes to the option volume. And I don't know, was it Wednesday or Thursday? Apple was like number 4 when it comes to the option volume. So and so there was a lot more volume going to some of the smaller ones. So we saw Tesla's, a lot of call option volume in Tesla. I don't know where the Tesla stock is, but I think it reached some 178 or 180. Yeah, almost 190. This was like all $100 to now 190, like 90% jump since the start of the year. So we did talk about this, I think, last week. Dave says Tesla was gamma squeezed. Yeah. So are we back with the risk back on? At least that's what the last week showed. If you look at ARKK from 29, just near the end of December to now 43, right? Up 35% in a couple of in a month. ARKK is a flagship ETF of Cathy Wood's ARK investment. Generally, this is a barometer for risk on assets. Mostly hold companies that are tech innovations, working on new innovations, which means by definition, you won't see any profits for next 5 years, 10 years. It does hold some companies that have profits. It does hold like Zoom, but mostly it's around a lot of a high growth, long-term focused companies. So it's up 35%. Carvana, right? This is the company that has declared bankruptcy, almost. It is up like 200%, or up 100%, I would say. Bed Bath and Beyond, they have come out and told that the management have told that they doubt that this company can be a going concern. And the stock, like, which was trading near $1.25, closed Friday at $3. Right? And this is what, like, annual spirits are back in the market. This looks like what we saw in Jan 2021. Now coming to the buzzwords, right? Last week we discussed that AI is the new .com/blockchain/ put up your whatever word you want to use for the speculative, the temper tulip bulb, and now it's showing up in the market. NFT, Web3, right? Remember in 2017, it was a Long Island iced tea. They changed their name to Long Island Blockchain, and the stock goes up 200%. We're seeing the same thing now in the AI side. Recently, 2 more companies got funding from AI at $500 million valuations. Right? Company talk about Chat GPT, like C3 AI did, and the stock is up from $10 from Jan to $29. Doesn't harm to come and say we will be integrating Chat GPT 3 into our product. That's all what they said. And the stock had a huge jump. Lucid, last week it jumped for no reason. I mean, there was no confirmed report that Saudi PIF is going to invest in it. There were rumors around it, and the stock is up from $8 to like $15. Now it has come down back to 11. BuzzFeed, again, creating a buzz out of a Chat GPT. They came with saying we will be using Chat GPT 3 to create a new content, and the stock goes higher. This is the level of craziness that we had seen in 2020. I'm seeing those spirits coming back in the market. So that's why I'm like, I got to be cautious. When the NASDAQ is up 11-12% in a month, NASDAQ is what, 14%, right? We saw it was 14% in the first month, and your own portfolio is up like 17-20% in a month. I'm like, guys, we made this is what you generally gain over a year. So time to be a little cautious. Right? Not that we're running away from it, but yeah, could pare down some of my deltas. That's what I'm focused on right now. Sam says, why do Cathie Wood's funds trade like active traders and not long-term holds? Because, I mean, they are active ETF managers. Now, I don't know why, but that's how Cathie Wood's is. And it is very specifically said that we are active ETF managers. So you would see Cathie buying and selling stocks almost daily basis. But they will share what they do very openly. Even if you are not a ARKK or any of the fund holder, you can subscribe to their daily changes. So if you're following Cathie, again, no recommendations, but I would I would consider the better approach would be to just buy ARKK ETF rather than trying to buy the stocks that Kathy Woods would buy, because you never know when she'll go not sell. So yeah, but that's been one barometer of risk on in the market. So looking at the earnings, we're not done here with earnings, even though it feels that, the last week was one of the biggies coming with the earnings, but still a lot of tech companies, a lot of other economy companies are still to report earnings. So this is what next week is. What about I be watching? Pinterest will be on my watch list. I want to see after Meta, how does market react to Pinterest? After Meta came out, Pinterest, okay, rising tide will lift all boats. Pinterest was also up 10-11%. But let's see what their earnings bring up. What else would I be interested in watching? Walt Disney, Affirm, PayPal. Yeah, I guess those are the ones that I would watch closely. I do want to see Robinhood, how they are doing. Uber is not now. Oh, Uber is there. Uber. Yeah. So these are some of the companies that I will be watching. Since it's Enphase, yes, Enphase is also reporting. Actually, I never studied Enphase as a company, so I haven't built an interest in Enphase yet. Or yeah, these were the ones that I do want to keep an eye for next week. UA. What is UA? Oh, United Airlines? Are they reporting? Other thing would be to see Activision Blizzard. This whole Microsoft and Activision Blizzard. This the acquisition. Under Armour. Yeah, Under Armour used to be, I think 4 or 5 years ago, it used to be a stock that interested me, but then its old CEO, after they started getting into wearables and all that stuff, they veered off too much from their core business. I didn't pay attention to Under Armour since then. Dave, now crude oil price is cheaper. I'm looking to buy some airlines. But if China starts, we see China reopening, goes well, crude prices may not remain lower. Okay, so that's all I think I'll be watching next week. So before we come back to US, I do want to talk about, and this was a lot of at least those, my WhatsApp group was lit with questions on who the heck is Hindenburg. Most of my friends from India what the heck is Hindenburg? Because we did see some furor created by Hindenburg in that part of the world. When Hindenburg had accused world third richest person of being just a con man. Asif is watching Aurora, and MBLY had a good earning. I never dealt with MBLY. What is MBLY? Mobileye. Mobileye came IPO recently anyway, right? Spun off from Intel. By the way, Intel had a good jump. Again, Intel earnings were pathetic, and the market punished Intel. but I don't know after earnings what happened the last week that Intel from it had like almost 15% jump in last week. Anyone tracking Intel do you know what happened? I mean, I do hold a small amount of share, but I didn't check what went on with Intel. Was it an impact of the Mobileye? I think Intel, even though they spun off Mobileye, but I think they still hold some stake in Mobileye. Anyway, let's get back here. Something little spicy stuff here is business plus politics and a short seller all coming together, become an explosive combination. It could be a great topic to discuss during dinner. So not many may be familiar with it. Probably those who have friends, family, or still watch what's happening on Indian business would know this group called Adani Group. Very well connected politically, and one of the biggest conglomerate in India. Hindenburg shouldn't be a surprise to us, but Hindenburg had accused the owner of the Adani Group of industries that it's nothing but it's the biggest fraud in the corporate history, and then Hindenburg had taken a short position in it. Right. So Hindenburg is run by Nate Anderson, and they have targeted almost 30 companies since 2020. The most famous, I think they came into consciousness of retail investors when Hindenburg gave out a short report on Nikola Motors in 2020. When some point of a time, Nikola Motors shares were almost $90. Now it is back to $1, $2. I don't know where it is right now. But it was Hindenburg who had exposed the shenanigans of Nikola Motors, and now the CEO of Nikola Motors, Trevor Milton, is behind bars. So it does have, the Hindenburg Research does have a lot of credibility when it comes to their accounting, forensics or investigative accounting. They are not journalists. So they're not doing for any altruistic way. They are doing because they've taken a short position. They are a short sellers. Right? But what they did this time, they had accused Adani Group. So this group is one of India's largest conglomerate, family-run business, and which had 9.3 billion in sales and has got a bunch of companies. Asif said, are you sure they are shorting Tesla? So I'm not saying that these are their current shorts, but at some point of a time, Hindenburg also went short on Tesla. Not every time, every short seller will get it right. So they didn't get it right when it came to Tesla. Right? But they, at some point of time, yes, they were short on Tesla. They pulled out, they did a short report on Tesla. Probably it's like a few years ago. Similarly, I mean, in 2017, 2018, and I know I've shared this story earlier. So I was about to put and buy Shopify. And then there was a short seller report on Shopify. I held back. And then Shopify went up like 10x since then. So yeah, so you have to do your own due diligence. But I think Hindenburg has a good credibility because they are right on 75 to 80% of their of their short reports. So their success rate is way, way higher. Right? So what they did, so Hindenburg issued 100-page report accusing this group of, at a high level, setting up a shell companies. Those shell company borrowed money from a lot of banks, etc. These shell companies are in, Mauritius and, out these tax havens. Then those companies were actually controlled by the families and friends of Mr. Adani, and then they bought shares of Adani. So what he's accusing is of share manipulation by using this offshore shell network, right? And this is a 100-page report. I didn't have a time to go through it. I think I'll need 1 week of vacation. And then Adani responded with 400-page of response. Okay. Then what we saw is the Adani shares fell down from almost 4,000 Indian rupees to now 1,500 Indian rupees, lost 60% of its value. The reason I want to bring this up is this time Hindenburg is basically picked up a very formidable a company to fight against, even though because this company is very well connected politically with in India with Indian government, and even though the company may be fraud, the fact that a lot of these shares of this company, the public float is very less. Most of the shares are held by banks, the pension companies, which are owned by Indian government. Some of these things work different, way different in developing countries than the way they work in the developed countries. The biggest non-group, family shareholders is the biggest insurance company in India, but that's a government-owned enterprise. So if government tells them not to sell, they just won't sell the shares, right? So, and some of in these developing countries, sometimes government have to build relationships, have to give some extra benefits, some give them some non-competitive advantages to the companies if they want to, help in the growth of their country. If you want to build roads, build ports, build power plants, sometimes government do tie up with these private companies and help these private companies to make again, it's both, right? They'll help these private companies to grow. Owners will make a lot of money, but yes, they will also build infrastructure for that company. The dynamics are different. And sometimes these companies, the attack on the company could be attack on national sovereignty. I mean, especially that's what I'm seeing. A lot of chat coming around that how come a company in US is attacking India? I mean, this is not India. This is another company, but this company is so intertwined with the government that maybe it'll be good to see. I mean, I'll watch this, how the battle happens. It could be too big to fail, right? But we'll see. Current situation is right now from I think now the number is $110 billion. By Feb 2nd, it was like $100 billion of the valuation was down. From 3rd place in Forbes, it is down to 13th place, 85. And Hindenburg says that they should see this go down 85%. Right now, they might have already closed their short position. Who knows? Well, we don't get to see that. But yeah, this was an explosive report, especially a lot of it actually disrupted even the proceedings in Indian parliament, and politicians had to they stopped the proceeding because they wanted to know why this one American company is attacking India. And there are a lot of conspiracy theories going around. But anyway, thought I'll share. There's a little bit of a spice in market. James, many of the exits have dubious history. Yes. And but in that part of the world, like in countries like China, India, Sri Lanka, you would discount the dubious history of those promoters. There have been many companies in India who had now become great companies, but when they started, the promoters has a dubious history. Promoters were in cahoots with the politicians. it was an open secret that the company have bribed the government agencies to win the contracts. So it's like I said, it's a different dynamics. And those companies, have some of them have become, $100 billion or $50 billion, really big companies, and have created a generational level of wealth for the shareholders. I'm not saying Adani is going to do that, but the dynamics are a little different than what the dynamics on the capital markets work here in US. So this time I do want to see how this pans out. Maybe this time Adani is against a sovereign power, not just against one company. The question then is the Indian government guilty by association? What we may consider as a guilt may be considered in the other part of the world as a price to pay to grow the company's infrastructure. So anyway, so jumping on to the next section is this is the first time we are meeting after the end of a month. So I always share what's the portfolio pizza look like. But before that, last week, long position change, I bought something on EEM because I still feel emerging market, US market is overvalued than emerging. I want to build position in emerging market, and bought a little bit on BlackBerry as well. Sold a very small portion Airbnb. I mean, I just wanted to get the position back to the whole number, and I had some odd numbers of long shares, so I just sold that. Nothing against Airbnb, but I just wanted to get a little, get to some whole number position. And anyway, I have some option position open on that. So main accusation is stock manipulation by holding more than 70% through the offshore shell companies. Yes. Yep. Tolerating fraud anywhere is tolerating fraud everywhere. I mean, so I don't disagree, but like I said, the dynamics are different. And the biggest question is, what was SEBI? SEBI is the equivalent of SEC in India. It's the Securities and Exchange Board of India. What is SEBI doing? Where are they sleeping? I mean, from that perspective, SEC was sleeping when a Bernie Madoff case was exposed. Oh, by the way, there is a connection between Bernie Madoff and this. Nate Anderson's mentor was Henry Markopoulos, the same accountant or the same analyst who had exposed Bernie Madoff. So he was Nate Anderson's mentor. So Nate has learned the tricks from the right person. So we'll see. All right. One more thing. Like I said, I've been cautious in reducing the delta. So in one of my accounts, is the first time ever, I think I could get as close to delta neutral as possible. I had just one delta position. Again, that means, it doesn't mean I don't have any stocks. It just means that the long stock position have been, that's what the hedge funds do, right? You have a long and short. So those long stock, the impact of the long stock position have been countermanded by having hedging positions that I'm almost delta neutral. Of course, in my other portfolio, I'm still long delta, which I try to actively keep in control because, like I said, I think we have overbought too much too soon. So I'm trying to reduce my deltas. But at least was happy to see this one delta. I don't think I've ever seen one delta overall portfolio in that account. Anyway, coming to the position of long stocks. Again, this is in spirit of transparency. I share the positions every month. At the end of a month, cash still continues to be the highest one. Next is SPY. Not much change, except that Meta has come up from below to now be part of top 10. Reasons are pretty obvious. Meta had a huge jump, almost 24% jump after earnings. So that resulted in Meta catapulting into top 10. Other than that, there is no change. So IWM has to give way to Meta. Right? No other big changes. Even though I sold off Melly, a little bit of a Melly last week, and a lot of you questioned, has my thesis changed on Mercado Libre? I've held this share for so long. Do you see it is not a good company? I'm like, no, even after that sale, it is still number 4. If you consider the individual stock, it is still my second biggest position. So it's just a little bit of a risk management, right? So that's the pizza for end of Jan. I still hold 70 stocks. Do want to reduce it a bit. All right, let's jump on to earning. Before that, any questions? Any other stock you're interested in my portfolio? There, so you are holding nice chunk of SPY. Yeah, so over the last few years, I have consciously trying to reduce individual stock exposure in retirement account and move that into just SPY. So on my non-retirement accounts, I don't have SPY. I have a hedge short positions on SPY, negative delta positions on SPY. All the SPY position is all coming from a retirement account. Why QQQ if I have lots of tech stocks? Yes, I'm heavy. Again, QQQ is in the retirement account. I have had that position, bought it in 2020 when the market had crashed, and just kept it over there. Yes. So I do balance it. If you look at on my active account, only thing I have on SPY and QQQ are the short positions, just to reduce it, compensate for my other tech stocks that I hold and the QQQ that I hold. Why are housing stocks going up? XHP. I didn't look into the housing stocks. So yeah, I am. One reason which I can think of is what's the mortgage rate trend? Is it going down? If the Fed rate, if the Fed is not going to increase rate in 2 quarters later, if it's going to be flat, or if it's going to come down, that's a good sign for a mortgage industry, right? So with the Fed, with the more dovish signal from Fed, is good for mortgage. So if I look at, so the interest rate peaked at 7.08. Now it's in a downward trend. That does bode well for a mortgage industry. ASML is a Dutch company. Yes. Chip. So they make an equipment, not they make machinery to create chips. ASML has a EUV lithography machines, and they are the only one in the world that has that. So my position is just because it's a monopoly, right? There is no one else in the world that can do it as of today. I think Huawei has filed a patent. Is it Huawei or some other company of China? But some company in China has filed a patent for the EUV, but perfecting the EUV process is not easy. And when we looked into the whole value chain of of semiconductor. It's like you need PhDs in physics, math to perfect that kind of a process. So it's not easy. That's why ASML is, I hold ASML. 70 different stock tickers or just 70 long stock positions. So these are my long stock position. So if I have some option position, that is not reflected here, because the current value of the option positions, I mean, I don't have like on monthly basis, okay, what's my current value of that option position. So this is the long stocks, the stocks that I hold in portfolio. So let's say if I have a 20 shares of GLD, those 20 will show up here. But if I have a put spread on GLD, and that is 10 delta put spread, overall it's 10 delta, that is not reflected here. Because that delta keeps on changing. GLD moves, the delta will change. So it's too much of a work to bring the equivalent delta of option positions. Alrighty. Moving on. Talk about earnings. We're all set for earnings. We're gonna talk about tech earnings. I think I have ASML. That is a residue from our last week from GM. Cool. So let's look at earnings. Meta platform, 32.2 billion. It was actually down. Considering that the stock went up 23%, you will not think that the revenue was actually down, but it was down. But it was better than feared, right? If you look at overall, it was almost 32.165 billion. They made 4.7 billion, again, down more than 50%. But story is, it was better than feared. Market expectations were even worse. And so if we look at last Q4 21, the net income was 10.2 billion. Now it is only 4.6 billion. CapEx, on the other hand, has jumped by almost 60%. And shouldn't be any surprise. Mark Zuckerberg had already told where he wants to invest. So that CapEx is still higher. But what's good is the overall users that are using Meta apps. So when you talk about family daily active people, these are the ones which are using Facebook app, WhatsApp, Instagram, all the family of apps. So almost 3 billion people in the world use one or the other Meta's property. That's why I still stay bullish on it. When Meta had crashed, whenever it was, I think I probably have a chart. We can talk about that later. But the engagement still continues to be good. Monthly active people means those who use the service at least once a month is almost 1/2 of the world population uses Meta platforms products. So from the usage and from the customer perspective, I mean, there's still no slowdown there. They have they have this captive market which they can they can benefit from. Okay, ARPU has come down a bit. In general, this will happen because as and when, sure, from a Meta perspective, not much expansion left in, let's say, the US and Europe. All the new growth is coming from the developing countries where you cannot charge advertisers the same rate that you can charge them in North America. So even though your usage is going high, your ARPU is less. So overall, if you look at their numbers, the ad impressions increased by 23%, but the average price per ad has decreased by 22%. Again, it also depends on the mix of the geography from where you're getting your revenue. What caused 23% jump is $40 billion increase in share buyback, right? So they repurchased $6.91 billion in previous quarter, and in this current quarter, and also got authorization to do another $40 billion of share repurchase. And as of now, they hold $40 billion on their balance sheet. So there were some cash. Where are they going to fund this $40 billion share repurchase? Are they going to buy from, are they going to raise money? Are they going to take some debt? No, I mean, it does generate some good cash flow. So they'll probably fund it through their cash flow. 40 billion is not that they're going to buy all the share repurchase in the next year. It's going to be over a period of years, and they will fund it through internal accruals. Right? So, but one thing I do want to bring forth is this is the company. They let go 10,000 people to save $1.4 billion. And now on the turnaround and give $40 billion to shareholders. Right? So let's not be any companies are telling everyone very clearly who they care more about. It's not about employees, it's about the shareholders. So we do the right thing, be the owner of a company. It's great. It's not bad that all of us have jobs. We are W2 employees. I am a W2 employee, but with full recognition that when it comes to company, even my own company, they will focus more on the shareholder than on me. Right? So for us, we need to act accordingly and try to become an owner or a shareholder of a company and not be satisfied just being an employee of a company. I mean, wherein if you are saying that I need to save cost, there you are giving $40 billion back to shareholders. Why not retain this $40 billion? Right? But companies work for shareholders, not for employees. Let there be no false notions around it. All right, what are the big themes? Emphasis is on being more and more efficient. So Meta does want to cut down a lot more, I would say, middle layer, managerial layers. They have had too many levels between the doers and when it comes to the top level, right? So they do want to cut down a lot more at a manager level. Probably they will still hire at an engineer level, but a lot more cuts we should see at a managerial level. Of course, do more with less. Two other priority areas are, today it is AI, and the long term it is metaverse. Now, Facebook or Meta is talking about AI. We'll also see Alphabet talking about AI. So why AI? To use a discovery engine, just like what TikTok is doing. Right? Become more of a recommendation engine than instead of showing you the content from the people that you follow. And then the next one is metaverse. I don't have to talk about metaverse. We dig too much into details of what Zuckerberg plan around metaverse is. So overall numbers were not that great, but the expectations was even worse. And if you go back when the shares were down 25% in some part of a time, I do have a chart for that. Yeah, over here, when the share had fallen down 25%, and we had reviewed that, and that time I said, this whole is, this drop or the problem with Meta is Zuckerberg's own creation. Their other side of the business is still continues to stay strong. So if Mr. Zuck pivots, we should see the shares going back up. And looks like in this particular earnings report, we did get a feeling that they kind of are pivoting in terms of how much money they're going to spend. The reduction in force is one. Continuous focus on being more efficient means we're going to do probably more layoffs 2023. And then couple that with a little more shareholder friendly gesture of returning $40 billion to shareholders. Market rewarded the shareholders, the stock handsomely. It's up now 25%. Again, from an outlook, also not too great. So looking at first quarter of revenue to be 26 to 28 billion, nothing much. Okay. This I do want to share this. So if you're not Twitter, I really like this way of presentation. Go and maybe follow economy app account. But this time I saw this does give a nice picture of where the company is making money and where, basically instead of your P&L where you read from top to bottom, this you read from left to right with a nice breakups, right? So overall advertising bring in 31.2 billion, others bring in 0.2, total family of apps bring almost, so total family of apps comes 31.4, kick in 0.7 billion from Reality Labs, full revenue is around 32.2. Pictorially, I mean, that's way easy to understand. Cost of revenue is 8.3, gross profit is this, right? So if you like to analyze companies, I mean, I find this account on Twitter really nice. So because it was Zuckerberg's own undoing, now he has come back and confessed that we need to do better in terms of controlling cost. Exactly what Brad Gerstner from Altimeter Capital had said in an open letter. And the stock that got punished is now being rewarded. So it's up 25% of the earnings. And in the sympathy, we also saw other social media stock like Pinterest was up. It hit a new 52-week high for whatever reason. I suddenly realized why this is up in my portfolio. I mean, I thought, did they announce earnings? No, but Pinterest earnings is next week. So I guess it is just in sympathy of overall risk on market and what happened with Meta. So that's on Meta. Let's move on to the next one, which is Amazon. And going back to Meta, revenue down, net profit down, outlook not that great, but there was so much of a pessimism, so much of a negativity that was built into the stock because of the capex on the metaverse, and the fact that Zuckerberg was hell-bent on it wasn't flexible when it comes to spending, but in this earnings result, we saw him to be more compliant to what investors are asking for and got handsomely rewarded. Talk about Amazon, right? Amazon overall sales is up 9% to almost $149 billion. Not great, right? I mean, it's single-digit growth. Microsoft also, we saw just 2%. So overall, not that great growth. Amazon is no longer high growth as a company, up 9% only. Operating income is actually down 21%. Net income is down 98%. So we should discount this especially when it comes to the companies that hold substantial positions in investment you should discount the net income because of new regulations, SEC and the tax regulations. The investment losses, even though you haven't sold, the book loss, the paper losses, you do have to take into account when you're reporting your numbers. So the reason why the net income is down 98% is because they had to take a valuation loss of $2.3 billion in their stake in Rivian Automotive. Right. So let's go and look at Rivian. RIVN. What did Rivian do in last quarter? I mean, the quarter ending December. So this is what, the September. So October, sorry, this one. From here, from $33 to all the way to $16, cut in half. And if Amazon is a shareholder and they hold big shares of Rivian, they have to take this charge onto their books. And that is almost $2.3 billion of a loss that they have to account for, even though it's a paper loss. So what we do want to focus on the companies like these, companies like Berkshire Hathaway, is not the net income, but the operating income. Because we don't control this. I mean, the stock market in a short term could do anything. But what we do want to judge company on is how good they are in managing their own business, which is what the operating metrics will tell you. So, even though operating metrics were still not that great, they were down 21% year over year. No surprises because of the cost, which now the Amazon has started to cut. We saw another cut announced, in January. One of the big business that we do want to focus on is AWS. Most of the big chunk of Amazon valuation comes from their AWS business, which was up 20% year over year. Whoa, 20% is great. May not be that great. I mean, it used to be 40% growth, but you cannot keep on growing at the same rate as and when you become bigger and bigger business. Now, AWS right now is almost $85 billion business, annual business. It is huge. There are some stats. It said that if AWS is a separate company, it has got more revenue than 450 companies of S&P 500. Can't believe that. Just think about it. This one portion in Amazon is bigger than 450 companies which are in S&P 500. So huge. It is so big. So when it comes to such a big, you can't keep on growing at 40% click. So AWS grew 20%, which did cause some worry because we do see the other competitors are growing at a higher rate. Last week, we looked at Microsoft. Microsoft grew at 32%. And if you do a constant currency, it was 38%. So in this case, they are on 20%. Microsoft is growing at 32%. I think these big companies for now kind of are peaked when it comes to the growth rate. And now the new additional share of the market share is being taken by the newer players, which is like we saw Oracle continue to grow at a higher pace. We are seeing Google expanding into this, and now the other one which could be coming is IBM with their hybrid cloud. Okay. I never looked at IBM, but now I'm getting more interested in looking at IBM and see how they are growing their hybrid cloud approach. Right? They have been very focused on hybrid cloud. So even though these three big ones, which is Microsoft, Azure, and Google are three biggest, I think when it comes to the explosive growth rates, both on Amazon and Microsoft, we as an investor, we should now start to see more of a mid-20s. If we get the mid-20s, that's great, right? And Google and the Oracles and the others probably will grow at a faster rate. Again, so but investors were a little bit concerned about this that the AWS grew only 20% year over year. Right? Free cash flow again down 28% year over year. It was even actually negative $11 billion. Overall shares constant. Not much worried about this one. Right? When I see the long-term goal, optimize free cash flow, my antennas goes like this. What we should, if I'm an employee of Amazon, I'll be a little worried. Long-term goal, efficiently managing dilution. You can achieve both of these, can capture these two or kill these two birds with one stone is by laying off more people. You don't have to do stock grants, so which will reduce your dilution. You don't have to pay them salary, which will also control your cash. So are we done yet with all the layoffs in 2022? I don't think so. I think there are probably more to come in 2023. So as an employee, keep my head down and keep working. That will be the mantra. Things are still not that great, won't be that great in 2023. All right, quick other things on Amazon is they expanded Buy with Prime to all eligible US merchants. They've been using Rivian for delivering packages. That's why they have a huge investment in Rivian. So they delivered 10 millionth package. Their investment on to reduce the cost of healthcare. They also launched RX Pass. Again, Amazon had bought one pill pack, one company. They also have one medical. So Amazon on getting into healthcare as well. Then some more announcement around the Graviton 3E chips, which will have a better price performance for AWS workloads and all that stuff. So yeah, I'm still as a shareholder, I'm still I have no concerns on this as a company just yet. Yeah, short term, yeah, AWS grew only 20%. The guidance is only to grow between 4 to 8%, which is very mediocre. But I think this company has a lot more cylinders to fire. So yeah, I'll still be and stay as a shareholder for this company. All right, what other thing? This thing we should talk about. The positive side is ad business. No one talks about ad. Amazon is not considered as an ad player. Was it 1 year ago? Or maybe less than 1 year ago, wherein we talked about watch out. Just wait to see how Amazon brings the ad business. Now, there are two companies that we're talking about. Amazon is one. We also talked about YouTube, right? 4 years ago, nobody talked about YouTube as ad business. Google didn't even break it down in when they reported their earnings, but now they do. It became a big business. Amazon never considered it as a company that makes money from ad. Slowly and steadily, this business is growing. So now ad business was up 20%. Probably the only positive high growth business is their ad business. And I think they still have a very strong lever to continuously grow this business. So just watch out for this ad business. Okay. Yeah, like I said, long-term goals, to me, it smells more of more layoffs coming in Amazon. So other thing is, when the cloud revenue was weak, the growth was only 20%. Suddenly Microsoft 30% growth seemed to be very good. And the Microsoft shares went higher after the Amazon results came out. Whereas when Microsoft had announced their own results, markets didn't like it. Right? Because the revenue was lukewarm, only 2% overall growth. And Microsoft Azure was just 32%. But now looking at this, 32% seems to be a great growth. So we saw Microsoft shares go higher. Right? Core e-commerce was down 2% overall e-commerce, but the marketplace, which is now equal to 60% overall business, means wherein they just are the marketplace for the other merchants to come and sell. They don't store the goods, etc. Was up 20%. Cool. What else? Let's look at this and see. Prime subscriptions brought in 13% up, almost $10 billion. Advertising up $20 billion. Online, yeah, this is overall $64.5 billion. So that's Amazon. Any questions on Amazon? Or
hey Vivek.
Hey.
So you said you are only shareholder of Amazon, right?
I am.
So you're into the stocks, or you're into the options in this, or both?
I mostly I'm on both. I hold stocks, then I use options to reduce the cost basis, or to get an opportunity to buy the stock at a lower price.
So you do the covered calls, or you sell puts on those?
Exactly. So generally I will have a put spread. In today's scenario, I mean, in whole 2022, I probably had a lot of covered calls. Now I have a put spread and a covered call. And if it try to go higher, I'll maybe convert it to iron condor. But yes, so Amazon is, when it comes to the long stock position, like we said, it is one of my top 10. Where did it? It is number 7 in my portfolio. And
that was your portfolio. I see. Yeah. I just joined, Vivek. So I just joined late. I just got to see the email just now.
Okay. No worries. Yeah. So after end of every month, in the first session, after the end of a previous month, I do share what I own in my portfolio, just from being more transparent, because I do come and talk about companies. So you should know what I hold in my portfolio. I don't want to be the one single I'm, pumping my own bags. So I just want to tell you what I own. Now you can decide when you hear good or bad things from me. You can decide and discount it based on what I hold in my portfolio. So yeah, I hold Amazon.
So is there a reason that you came out of the IWM?
Oh no, I didn't.
If you already took care of it, that's fine. We can discuss offline.
So here's this. I own 70 stocks in my portfolio. I showed top 10. So IWM fell out of top 10 because the Meta came in top 10.
Oh, so IWM is still there as a top. Okay, I got it now.
Yeah.
Got it.
Meta shares were up 24%. So from down, it came into top 10, then something else had to go out of top 10. That was IWM. I still hold IWM in my portfolio, but not in top 10 anymore. This is this is the IWM slice.
How do you manage so many positions?
You got to put, so many of the positions are, some of them are ETFs, right? And then I have to put in work. I mean, I keep an eye, I look at, go through the earnings of at least the one which I hold in top 20. I do want any individual stocks. I do want to focus on, what they're doing from earning perspective. Yeah, I mean, you got to put in work. Yeah. So that means no Netflix movies, no watching TikToks, and all that time goes into I mean, for me, it's fun. For me, I don't think it as a work. I enjoy doing this. So, I get my fun from reading 10K and 10Qs or watching, looking at earnings slides than watching a movie on Netflix.
Yep. No, I totally hear you. Thank you. Thank you for sharing that.
Alrighty. Yeah, welcome to the group. All right, next is Alphabet. So let's look at Alphabet. And and this is the so there are two companies which I hate when it comes to shareholder friendliness in terms of giving information about their earnings. And I've talked earlier also, and one is Alphabet and the other one is Apple. I mean, if you go and look at the investor relation page of Alphabet and the Apple, it's like they just throw you something and you have to do a lot more homework. Other companies will give you information like Amazon. All these charts that I shared are all from Amazon's own earnings deck. Meta, they give you all this information from their earnings deck, right? Alphabet, no earnings deck. And you have to now dig through it. And I didn't have a time to now create and dig through it as a W2 and, working as a part-time investor, I would love if they can help me by giving me some charts or comparative, but it is what it is. So anyway, so let's look at what Alphabet showed. One thing which captured my eye was Sundar Pichai talking about AI. And why not? Microsoft has openly talked about their investment in ChatGPT-3. ChatGPT-3 has caught fancy of everyone in the world. It is a new buzzword now. You bring in ChatGPT-3, your stock goes higher. We looked at a BuzzFeed, we looked at C3 AI. So why not? So here, Sundar Pichai talking about our long-term investment, deep computer science, make it extremely well positioned as AI reaches an inflection point. And I don't doubt about it. Many of the engineers in OpenAI, the company that is behind ChatGPT-3, came from Google. They use Google TensorFlow, which is their, for the deep learning and building AI products. So Google has been in this way earlier than any other company. But there were reasons why they did not come up with an open product like ChatGPT-3, reputational risk damage, risk of litigations and whatnot, things that we talked about in some of our previous sessions. But now, the moment you talk about AI, people get excited, market get excited, your shares get higher valuation. We do see Sundar Pichai coming and talking about AI in this earnings call. What's more important is, was it this company? I think it is. Somewhere they mentioned that they're gonna now break up and the revenue and show the revenue coming from their AI division. Hold on, I think I read that somewhere. But anyway, let's move on. So overall, revenues were up 76 billion, 1% year over year. 1%? What are you talking about? These are like companies like Amazon's, Apple and Apple's and Google's are considered growth companies still, right? And they're up only 1%. Year over year, the quarterly revenue, that doesn't sound good. So again, I think from a just looking at the numbers perspective, all the three big companies, Apple, Amazon, Google, AAA's, they didn't do well. But the market was more controlled by the Fed narrative. But we saw the shares of all these three companies just went high. So overall revenue was up only 1% when you look at quarterly revenue. Yearly revenue, it is still $282 billion revenue. It's no joke. It's one of the biggest company on US market, $74 billion of operating income, and 59, almost $60 billion of net income. What I am more interested is here. This is given. Search is going to be the biggest one, always has been. YouTube ads is actually gone down. And this same thing we saw even previous quarter also, saying that YouTube ads, the revenue that they're generating from YouTube ads is actually have gone down as compared to 2021. It could be because of engagement, but I will get worried if we continue to see this trend even next year also. And YouTube is taking steps to attract more content creators by giving them more incentives, but we have to watch it. It's been 2 quarters that I'm seeing this, that it has gone down as compared to the previous quarter. I don't know if quarter-on-quarter basis, how the numbers look like. Quarter-to-quarter basis. Oh, let's go to investor relations page, Google. Or maybe I can just bring up, I want to see what was the revenue in the previous quarter. Means Q3. Okay, so let's bring this up. Q2, yeah, Q3. Oops. What was Q3? 7071, and Q4 is 796. Okay, so quarter-on-quarter it has grown, but as compared to the previous year, it's down. Okay, Google Cloud. So 2 things to keep watching. Google Cloud is growing at a healthy pace. This is what I like. This is their this is where the Amazon got most of its valuation. This is what drives the valuation of Microsoft. Windows is slowing down. No, people are not buying that many PCs in 2023 anymore. But their cloud is growing. So is Google Cloud is growing. Other bets are there, Waymos and whatnot. Hedging gains or losses is 669. So their treasury, the group is doing really good. I don't know what they're doing, but you making 669 on your hedging. How much do I have its balance sheet? Yes. So you're holding $113 billion of cash. So you need to hedge that anyway. So which is whatever. This is the peanut change for them. So overall, I think the numbers were not that impressive. We did not see the cost of the benefit of the reduction in force that Google had announced just yet. Rather, I think they have taken some charge for for employee layoffs. But I guess the reduction in their force will start. We should start to see the impact of that in 2 quarters, which would be a tailwind for the overall results. What else caught my eye? This one. No, sometimes these are I won't say games they play, but I do get a little angry about why the heck. So what Google also did in January, we completed an assessment of useful lives, and we decided to change the useful life of our equipment to 6 years. Right? So, as a normal investor, you may not worry about it, but to a trained eye, you just start to think about it. That means you can now artificially, I wouldn't say artificial. Okay, I'm not saying that the Google finance department has any, they're trying to cheat, but these are the things we should know, that some of the results are, when it comes to the net profit or the cost will go low because they've changed the useful life of their servers. So it means every year the amount of depreciation that they have to take will be less. It's a non-cash expense, but it is an expense. So now arbitrarily, I don't know what method these companies use. Now you've reduced the expense. James says financial engineering. Yes, you got the right word. It's a financial engineering. And this is not the first time they're done. So they started with it by increasing from 3 years to 4 years. Then they increased from 4 to 5 years. Now they're increasing from 5 years to 6 years. Right. Asif, not just on paper change, they have to make sure hardware survives. Yes, I mean, yes, that is true. But what do you mean? I mean, as a personal laptop, or if you buy a laptop for your business, you can depreciate it over, let's say, 3-year period. Laptop may still be good, right? But they were doing that even earlier also. So I'm not saying that there's anything bad in it, but it just gave you, I would say, it just reduces your expense by maybe if they are not refreshing. Let's look at what their I don't know if they have shown their capex number. So I should then ideally see the capex number going down. Okay. If that happens, then yeah, it will make sense. Okay, the other thing was now AI, they will start to report on an AI segment separately, which is great because now every company is now focused on AI. So beginning in January 2023, we will update our segment reporting relating to certain of Alphabet AI's activities. So probably DeepMind, which is currently buried under other bets, that DeepMind will be reported as a part of Alphabet corporate cost. Okay, so they're gonna show more, focus more on the AI side. That's all good. Overall, from assets, I mean, again, no concerns around this company. In the whole of my 2020, I never held positions in Google. So I started building for the first time in 2022. I love this company, and strong balance sheet, and they got a huge amount of a talent to continue to deliver what they are. So zero concerns. Overall, looking at a free cash flow, you look at $60 billion of free cash flow. They can do a lot of things with this $60 billion. Pay out dividend, continue to do buybacks, buy some companies. This huge amount of cash flow gives you a lot of optionality. So still bullish with Google or Alphabet. Cool. Next, let's talk about Apple. We hit 12 mark. All right, we'll quickly go through it, maybe another 10-15 minutes. So Apple is the second company which doesn't do a good job of sharing the information about their earnings. If you go to Apple investors page, I'm like, gosh, why you make me do so much of a work? That's all they have when you go to their investors page, is one press release, and then either you can go to the financial statements. But anyway, I try to break it down. Revenue is down 5%. right? Microsoft increased 2%. Amazon increased 9%. Alphabet decreased. Oh, sorry, I just forgot. Alphabet was decreased or increased? Alphabet was the increase of 1%. Whereas when it comes to Apple, we saw the revenue actually going down. It was down 5%. Challenging environment, and the one of the big factor why it was down is because of iPhone shipments. They were short almost 8 to 10 million iPhones, and because of the supply chain issues, so all that revenue is not lost, but probably will shift toward the next quarter. So, but whatever it is, in this quarter they were down 5%. Good thing is they have more than 2 billion active devices, means a captive user base that they can monetize, and that monetization is very evident in the record services business. $20.8 billion of revenue coming from services, and this wasn't even any business 5 years ago. So within 5 years, they have grown their services business like crazy. $34 billion of operating cash flow, $25 billion return to shareholders. Pretty solid company. This quarter have been bad for many of these big stocks when it comes to the business as compared to the previous quarter, but not at all worried about this. Again, they declare a few more dividend. I was reading about some stats saying overall in its lifetime, Apple have returned $1 trillion back to shareholders. I don't have any proof of it, but I think I heard it on some podcast. So still, I'll continue to hold Apple. The worst, if you look from a summary perspective, revenue was missed, EPS was missed, EBITDA was missed, iPhone revenue was missed, variable revenue was missed. Only thing that worked in this time was services. Right? Stock was beaten in after hours, but Friday it closed up like 4%. Figure out. That's the fun of short-term stock market moves. I have no idea. Only we can have only guesses or theories. My theory is that market suddenly woke up and say, they got more than 2 billion devices with people, more than 2 billion devices in the hands of people. And now they have also figured out or becoming better and better in increasing their services revenue. So got a 2 billion devices, you can sell them a lot more stuff. Sell them some subscriptions. And then they're like, okay, I don't think this is company, that its earnings are bad. The services revenue and more than 2 billion devices with both a record is a potent combination. Oh, I want to own this stock. Again, someone else might have a different theory, but the fact that after earnings announcement, it was down 4%, but next day it was up 4%. Anything can happen in a day in the market. That's why it is almost impossible to predict or say what stock gonna do after earnings. Even if you give the earnings to me, before it is announced, you can still can't figure out whether you should buy the stock or whether you should sell the stock. Earnings movements are crazy. Asif, only S&P top 10 companies still growing revenue profit double digit is Tesla. I agree. Tesla's revenue was up. But again, Tesla's valuation is also equivalent. And it boggles my mind if you look at their operating margins. It's like 16%, around that. from that perspective, unless it's a fraud, it's a great, the way they are running their business is great from operations perspective. Next is General Motors. General Motors, they actually beat revenue. And I think that's all market wanted to hear. They beat revenue, their focus on EV, and they also did an investment in a lithium mining company, because when you're trying to focus on EV, lithium is one of the most important component in your EV batteries. So you need to make sure you need to secure your supply of lithium. So GM had jointly invested with Lithium Americas, blah, blah, blah. So investment of $650 million. Okay. Guidance for the full year is between $8 to $10 billion of net income, free cash flow around $7 billion. Again, GM, Ford, these incumbents have a long way to go to catch up with the market. Not catch up, I think probably, not sure if they will be able to catch up, but to gain meaningful share from the market leader. But make no mistake, these companies are doing it. GM has been executing on their strategy more than, I think, till mid of 2021. Their strategy was a vaporware or slideware, like we call it, right? It was a slideware. But from mid 2021, Mary Barra came and shown to investors that it's not only slideware, they're actually putting their strategy into execution. And we are seeing this. So GM stock was up 7-8%, I think, after the earnings announcement. Yeah, it was 8.35%, and post that, the general market enthusiasm has taken it even higher. So, and the final one from our previous week is ASML. ASML had, because that's a Netherlands-based company, they report their results in euro. Right now, I think the euro and dollar are pretty close by, so the conversion is okay. Anyway, I don't want to don't try convert it, but the net sales they beat the expectations, and so which was $6.4 billion. More important is, out of that 6.4, 3.4 billion euros came from EUV. Means more than 50% of the revenue is coming from a segment where they have zero competition. There's no other company which builds EUV machines. They are the only one, right? So which is great. They do have other machines also, like DUV, but they have competition in that from, I think, Nikon or Canon. They also build it. Then there are some other companies that have the same machines, but when it comes to EUV, ASML is the only one. Okay. Gross margin 51.5%. That's all is okay. Guidance is this. Guidance. Can be quiet. All right. Guidance is still, they expect the sales to grow over 25%. There were concerns around ASML saying with these restrictions that US and its allies are putting on China, how will that impact ASML? China told that not much, because the machines that they're selling in China are not under those restrictions, right? The second thing that we should watch about when ASML is the value of fast shipments, which will be recognized in 2023, is $3.1 billion. Now, this is great, right? So it's their machines that they build, there was so much demand of these machines that the customers had asked them to ship the machine to their premises even before they were completely certified by ASML. And we talked about it in one of their previous quarter earnings, and they mentioned that we can't recognize the revenue even though we have sent the machine to the customer premises, because we only recognize the revenue once we have completed our testing, and then we recognize the revenue. But customers wanted the machines quicker, so they did a fast shipment. But those machines, the revenue recognitions was delayed. So now that will get delayed of almost $3.1 billion of revenue should flow in 2023 from the machines that were sent to the customer, but they couldn't recognize the revenue yet. They intend to declare the dividend for 5.80, which is 5.5% increase. And they also announced some share buyback. All right, what else is happening with the chip industry? Because it won't be, it's in chip segments, won't be immune to what happened on the chip. So it is not this Friday, not the Friday that's gone by, but the previous one, which means 27th. On 27th, there was a deal done between Washington, Netherlands, and Japan on putting restrictions on what you can export to China. So Netherlands will ban some immersion lithography gear, and so I think ASML, Nikon, and Tokyo Electron, these are the three companies which build a lot of machinery related that you need for a chip manufacturing. So, but ASML said that, hey, they don't have much effect on the 2023 earnings. So I'm still bullish on ASML. Only thing that I don't like about ASML, which I don't like about my other biggest holding, is their bid-ask spread when it comes to options is big. Right? Trying to reduce your cost basis through option selling is a little challenging on ASML as well as Mercado Libre. Right? But other than that, I have no concern on its business just yet. So we'll continue to hold ASML.
Just another follow-up thing, Vivek, on the selling covered calls. Normally, how far in the time you go with what the delta when you actually sell the covered calls?
So generally, I'll go around for anything between 30 to 60 days. Okay. And the delta I'll pick up is, if I want to get rid of the stock, then I'll pick up 45, 50 delta. Right? Instead of me selling in the market right now, I don't want to hold the stock anymore, but rather than selling right now, maybe I'll sell at the money covered call. Generally, when I talk about covered calls from a cost basis reduction perspective, it means I'm still bullish about the stock, but I want to reduce the cost basis. I'll sell delta, which is less than 20 deltas, 16 delta, 15 delta. Again, my intent there is to just make some little bit of money while I'm holding the stocks, right? It helps you to hold the stock through the downturn and continuously reduce the cost basis.
Okay, makes sense. Thank you.
And you won't, at least personally, you don't see the impact of doing this once or twice. You do it over years, then you realize, this option selling is such a good tool in terms of reducing the cost basis, right? Right now, I think I have 4 or 5 stocks wherein I have a zero cost basis. In some cases, I have a negative cost basis because I've sold so much premium over a few years that those are like all sponsored by, I've already made more than what I put in, and I still hold all the stocks. But it takes time. You won't see it, by doing 10 times. I just keep on doing it over and over. If not, if I don't hold 100 shares, then I'll sell a call spread. I never would want to do an uncovered call in an individual stock. But as an individual investor, I've decided that one thing I want to focus on is cost reduction.
Yeah, it makes sense. And then just the quick follow-up. The premium you collect, even if it is small amount over the time, it will become reasonably a decent amount. Do you actually just take the premium and then buy the same underlying stock back, or what you do with that?
So that's up to me. I mean, whether I buy the premium or, that's basically the cash which comes onto my, it's my account. I'll utilize it whichever opportunity I find. But I do consider, when I'm looking at my cost basis, I do consider that, okay, it has this option premium has reduced my cost basis by this amount.
Got it.
So reinvesting is a separate decision. Let's say if I still want to increase my position by, on the particular ticker, maybe I'll reinvest in it. Right? But if I think that position is from my portfolio perspective, it's a big enough a position, I don't want to add to it, then I'll not invest into the same ticker. But maybe I'll use that money to do something else, buy something else. So right now, if I look at NEO, I have negative $5 is my cost basis. I have XLI, which is negative $10 of cost basis. I have Baidu, which is negative $100 of cost basis. So yeah, over a period of time, I mean, you have to keep, and then I have a like BlackBerry, which stock purchase price is $6, but right now my cost basis is 55 cents, right? And some of these Reddit, I mean, BlackBerry, my thesis is not Reddit driven, but they're focused on cybersecurity, and their new CTO that they hired, Mr. Shishir Singh. I've looked at his history, and so I've been building BlackBerry position for some time. But now, how do I care? And my cost base is 55 cents. So again, I still have position on BlackBerry, option position, probably will go to zero cost basis in a few months. Right? Then stock goes down to zero. Yeah, it hurts, but I have already taken up all the money that I invested in. So that's why I emphasize a lot more on cost basis reduction. It helps you to go through the downturns in industry.
Yeah, I'm totally with you, Vivek. And it's a good problem to have when your cost base is reduced that dramatically.
Yeah. All righty. I think that was the end. Any other last minute questions, etc.? Anything else? No fans of crypto? No one asked me about crypto this week?
Yeah, so what do you think about crypto? Like, crypto has gone so dramatically up, especially SI and other things. Oh my God.
SI? Oh,
Silverlight.
Oh, Silvergate Capital.
Silvergate Capital, sorry.
Oh, I don't know. Is it ticker is SI? Okay. Again, Silvergate is a bank, the only crypto bank. So overall, right now the crypto is up because all the risk on assets are coming back up. But if you want to be in this space, you have to have at least. I don't want to talk about you or anyone else. If I want to be in the space, I have at least 20 years of outlook. If you need anything before 20 years, I don't want. It's not the space to be in. It's really long term, and in that 20 years, it could go down to zero, or it could go. When I say go down to zero, let's talk about a Bitcoin, that the flagship token we talked about, is it could go down to zero, or it could go down to million. So it's such a big, I would say, huge variation in what you can do because of the amount of risks. So unless you are able to go through that volatility, I would say stay away. But I'm okay to hold up, over a 20-year period. If it becomes zero, whatever I take positions in, it's fine. It's over a 20-year period, right? I can afford to lose that at a 20-year period. But if all things become zero and next year and I needed that money, that's not a space to be in. This week, I got a little worried about what I saw on the Bitcoin's ecosystem specifically. Reason is, so far Bitcoin's, there are different projects. Bitcoin's was specifically focused on being an alternative to, I would say, Fed printing. It was like an insurance against the world, the central banks over the world just printing money out of thin air. They were focused on just becoming a store of value to hold. But this week, a new protocol has been introduced called Ordinal Protocol. I didn't get a time to dig deeper onto it, but that has kind of divided the Bitcoin community into two portions. We saw a similar division in 2017 when it came to increasing the block size. Now we are seeing this new protocol introduced in which you can mint NFTs on Bitcoin. And some of those who are purist on Bitcoin, they're like, what the heck are you talking about? Why are we bringing all this crap stuff from other, which happens in other chains like Ethereum and all that? We're bringing that to Bitcoin. It is going to increase the amount of, increase the size of the block or the data that you can push in, and it's going to increase the cost of minting a block. We shouldn't be doing it. On the other hand, the developers that who propose this protocol, they're saying it's an open ecosystem. People should be allowed to build whatever they want to build. And this week I'm seeing like back and forth around that. I'm like, what's happening? So that does concern me. Other than that, it's a 20-year game. I'm still holding it, still watching the projects that are happening here, and not watching Dogecoin. But if Twitter decides to adopt crypto payments, which Elon Musk has told, he has mentioned that Twitter will adopt, crypto payment. Who knows where the Doge will go? But that's not something I'm watching. That's a quick spiel on crypto.
So Vivek, you normally have only the Bitcoin and Ethereum, or you also invest in the alternate coins too?
I do a few alternate coins where I have done some study, and I have a little more idea about in terms of what they're doing. But majority, my focus is on. So here's the deal. Who asked a few weeks ago? One of my friends had asked me. So I said, Bitcoin is gold, Ethereum, silver, maybe. All others is Vegas bets. Yeah, you're buying something or doing that. Please understand that's a Vegas bet. You're a Vegas bet. Will pay off. If you lose everything, make sure you don't put in that you need for your survival. I still hold that thesis. So yeah, my biggest one would be, when it comes to crypto, it would be Bitcoin and Ethereum. But I do hold some others as well.
And do you normally go directly into the Bitcoin, or you also do like ETF, GBTC?
GBTC I had done because the GBTC is being, it's heavily discounted right now. But the concerns around GBTC, I'm still watching what, after this whole Genesis, I'm not sure if you've been tracking that, but the Genesis Trading, which is owned by Digital Currency Group, which also owns Grayscale, this issuer of GBTC. This is the closed-end fund. So you can't, right now it's being traded at discount. So if you can hold it until it gets converted to ETF, or until the problems with Genesis and the DCG are solved, until then there is a risk. But right now, I don't know what's the discount to NAV to GBTC right now is. But I do hold because you can't buy Bitcoin in your retirement account. So one of a small IRA, I hold GBTC. That's the only way you can hold it. And that's like, I had one Roth IRA, very small. So I'm like, I have a 25-year long thesis on it. I might as well hold it in my Roth IRA. So GBTC to BTC discount. So last I bought when the discount was at 30%. Now it is discounted 43%. Yeah, for right now, for my investment, I mean, whatever, it has reached the percentage that of my wealth that I wanted to invest in crypto. I've already reached that, so I'm not added anymore. But I think last time I did probably was when it was 30% discount. But yeah, if you think that the grayscale will be able to get an ETF, convert the GBTs to an ETF, you have a 42% of return. You know, $100 stuff, you're buying it at $58. Because if it gets converted into ETF, this discount will just vanish. Today, this discount is because it's a closed-ended fund, and there are concerns around Grayscale as an issuer, DCG as its parent company. That's why you see so much of a discount. Market is discounting this. James says SI fell after market due to DOJ investigation linked to FTX. Yes, I mean, they are the only crypto bank. So whoever is linked to FTX will be investigated except the politicians, right? Everyone else, DOJ will go after. But they won't go after the fact that how come Sam Bankman-Fried, FTX got so many licenses so quickly, while many of the other companies have been waiting for similar licenses and had to go back and forth with authorities with a lot more information. But FTX, when they wanted to start their US operations, they got a red carpet treatment. I'm not sure. I don't think the DOJ is going to investigate that. There are way bigger fish involved in this. So, but it is where it is. I mean, this is a wild world. So position size it accordingly. No investment is good or bad. Only thing which is good or bad is our position size. One thing I've learned. So size it accordingly. All right, guys, I think that's it for today. Thank you very much. And let's stop right here, and we'll talk again next week. Thanks a lot.
Vivek, is it a weekly session?
Yeah, every Saturday, 10 a.m., unless I cancel it on Meetup. I mean, if I'm traveling or anything, then I'll cancel it on the Meetup. Otherwise, it's 10 a.m. every Saturday.
Got it. All right. Thank you. It was really good conversation. Thank you very much for all the information.
You're welcome. Great to have you here. And we all learn from each other, guys. We all learn from each other. I'm a DIY investor. I have my own W-2 job, so I don't get too much time. So I come here so that I can learn from you as well. So thank you.